Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. It is no secret that the financial services and broader investment management industries are dominated by men. In fact, women make up anywhere between 25% to 30% of all financial advisors, despite women being the majority of the population at about 51%. Additionally, it is well known that we are embarking on a $30 trillion generational wealth transfer that is sure to impact the financial services industry. So, with March being International Women's Month, I have a fantastic guest on who will help us understand the gender gap and ongoing trends that will impact the financial services space moving forward. But first, today's episode is sponsored by the award-winning Zephyr. Zephyr is a financial services solution and data provider, giving investment professionals the tools to plan, invest, monitor, and grow, enabling better service and client engagement to achieve their clients' financial and personal goals. So enough for me. I am honored to welcome Haleh Moddasser. Haleh is the managing partner at Stearns Financial Group. She is the lead advisor of the Chapel Hill office, where she works with clients of all ages in all stages of life. Haleh is also leads Stearns Women's Advisory Practice, where she focuses on issues surrounding women in finance, as well as ESG investing as a tool for creating social change. In addition to all that, she is the author of 2 books, Women on Top, Women, Wealth, and Social Change, and Gray Divorce, Silver Linings, A Woman's Guide to Divorce Over 50. Haleh, thank you so much for coming on the show. It's really an honor to have you on. Can you please just tell us a little bit more about yourself and Stearns Financial Group?
Absolutely. So Stearns is a $2 billion registered investment advisory firm. And I got into the business mainly because I was a career woman who took time off to raise kids and found myself in an unexpected divorce, feeling like I had given up my earnings power and looking for people to help me as I navigated that transition in my life, found that there really just weren't a lot of people that were finance people to assist women going through divorce. And so I didn't necessarily set out to make this a niche for myself, but I kind of fell into it through my own personal experience and also just people who knew me who suddenly found themselves in the same position started coming to me for help.
Mm-hmm. Interesting. You mentioned you gave up your earnings power to, have a family and care for your kids, which, fantastic. There's a lot of women that do that, right? It's very common. And, there's, especially in the sports industry, right? You see it all the time, just across the board. Is that something that, maybe is changing, or do you see that still happening where women are forgoing? In a way, it's a risk too, right? After you raise kids, you're a little bit older, and then all of a sudden you're worried about, well, am I hireable? And how do women think about that?
I think it's a huge risk, honestly, because women, because of childbearing years, often earn less in Social Security on their own because their trajectory is not the same as men's, right? I mean, even if they stay in the workforce, they're kind of scaling back. And I think if the pandemic taught us anything, it's that women are still the ones who are taking care of the family and the kids. That's why we had 5 million women drop out of the workforce during the pandemic. They were homeschooling, they were preparing the meals, taking care of everything. And so it's hard on women because I don't believe you can do it all at the same time. Something's got to give, right? And so my suggestion for women is have that career, build a skill set, try to keep your foot in, but you don't have to deny yourself the joy and luxury of raising kids. I mean, that's part of being a woman and a mom. If you want that, you should be able to access that without fear of never being able to be employable. The women that I find that are less employable, that have gone through a divorce or widowhood, are the ones that usually never had a career. They don't really have skills, and they don't have confidence. I mean, confidence is a huge factor. If you're going to go back to work at age 50 after being home for 20 years, you better have some confidence and some moxie, right?
Very good point. Very good point. Yeah, it's very interesting. Like you said, the pandemic just kind of threw a whole wrench into it too, right? That changed some things. And you mentioned divorce, and divorce has picked up, I think, during the pandemic also. It's just interesting dynamics for women. So in our earlier conversation, I mentioned my mom has been a widow for 15 years, and it was my dad who handled all finances, just everything. My mom had no idea
Right.
where money was at or anything. And that's a problem.
So
How can
typical.
a financial advisor, yeah, exactly, how can financial advisors help that situation, or for women, for widows that were very hands off?
Well, so let me just tell you an interesting statistic. This just blows my mind.
Okay.
But I wrote a book on, and as part of the book, I surveyed 500 boomer women that were high net worth.
Okay.
That meant $500,000 or more in their own name. It could have been inherited, they could have worked and earned it, but they had assets.
Yeah.
And I asked, and these are boomers, so you have to keep in mind the age group. This is my generation. It's not young, it's not millennials, right? So I asked them, who do you think is a better investor, men or women? And shockingly, and I mean, I'm shocked by this, women, only 12% of boomer women believe that males are better investors.
Really?
12%. So I don't know what gives if a woman believes that she actually is a better investor than a man because she's watched her husband or her brother or her uncle or her male advisor buy and sell, try to time the market, you know, buy high, sell low.
Right.
And she's sitting there thinking, I could do this better than you. And yet she delegates that to her husband, to her son, to her uncle, to her male advisor. Why? I don't know. I have to believe this is something about the way that we're raising girls,
Yeah.
where it's just not very sexy to talk about money, that this is a topic you should defer to men. And so it's unfortunate in my opinion, because women, as you alluded, currently control the majority of the nation's wealth, upwards of $20 trillion. And by the end of the decade, that's $30 trillion. So if you're going to control the majority of the wealth and you're going to outlive your spouse,
Yeah.
I mean, the average age of widowhood is 58 years old, which is shockingly young. Why would you delegate this thing, investment management, your retirement, your financial security, to someone who's probably going to predecease you?
Yeah.
I mean, at least stay involved in the conversation, at least know what you've got, right?
Right.
Yeah.
Exactly. So I have so many questions for you just based on that, your comments right there. Let's start with that gender gap, right?
Yeah.
That gap between, just why aren't women more involved? What can be done there? Can financial advisors help there, or maybe just education growing up? Like, what can be done there to narrow that gap or remove the gap?
I really think if the future of investment management, at least for the next several decades, is women, that it's incumbent upon advisors, both male and female, to engage that woman if she's married or not,
Yeah.
right? Don't, what women overwhelmingly complain about is being talked down to or talked over or ignored in meetings, or being told that they're risk averse and that they should trust their male advisor who's going to make so much money for them. And women don't think about money the same way as men do. Women are chasing security generally, long view, legacy, make the world better for your kids, create a better future. They're not trying to generate alpha per se.
Mm-hmm.
It's not that they don't want good investment returns, but it's a lot bigger than that for women. And so if as a male advisor or anyone sits down with a woman and starts telling her that she's risk averse and she should go into this derivative product or this hedge strategy, and that's just not the way to get through to her. She's going to shut down. And what she wants to know is, am I going to outlive my assets? Am I going to be able to leave this money to my kids or my alma mater? How much do I expect to have? And that conversation's just got to change.
Yeah, you're exactly right. And going back to women that are in their 60s who are widowed, I hear so many horror stories of advisors. The first thing they ask is, well, or the first product they offer is an annuity, right?
Yeah.
It's like
Yeah.
always about the annuities, and it's any elderly person, right? Whether it's women or if they're, and I feel as if that's got to change on how financial advisors offer their services to the elderly.
Yeah, I think so. I mean, that the annuity is driven by fear, right? And so you already have a woman who's vulnerable. Either she's newly divorced or newly widowed. She's probably not been that engaged in the financial markets, her own financial planning or retirement assets. And then someone comes along, the knight in shining armor, and tells her that he can guarantee her income for the rest of her life. And that's appealing. She might believe that the markets are smoke and mirrors. Somebody has to educate this woman. I mean, the stock market's been the greatest generator of wealth in this country, not annuities, right? And so the education is key. And let's not wait until the husband dies. Engage that woman in the conversation, honor her. Don't let her feel like any question is stupid or talk over her head to the husband and dismiss her. There is a stat out there that 70% of widows fire their advisor within 1 year of the death of their spouse. 70%. Because that relationship was with the husband, not with her. And so if in the industry, you just mentioned 4 out of 5 advisors are males, if you don't want to lose those clients, you have to engage the woman throughout the relationship. It can't just be play golf with the husband, give the husband a call at work and tell him about crypto or whatever it is that he's excited about. You have to engage really in financial planning and a long view with the woman.
Very interesting. You talked too about how women are better investors than men. Why do you think that is? And you mentioned a couple things like market timing and stuff like that. Do you think there's like maybe just like a silver lining there, or something that maybe makes women better than men in
Yeah, I mean,
investing?
there's actually a book out there called Warren Buffett Invests Like a Girl, and So Should You. And the reason is that women have the long view, and we all know the stock market works in the long term, not the short term. So markets go up and down. I mean, the Fed sneezes and the investment markets catch pneumonia, right? And
Right.
so you can't time the market, you can't stock pick, you have to have a disciplined asset allocation, leave it in place over the long haul to achieve that long term, depending on your risk tolerance. But a 60-40, we expect a 7% rate of return, which means you're doubling your assets every 10 years. If you're buying and selling in the interim, you're not going to achieve that. The average investor achieves approximately inflation, which means you're making no money. And so women have that long view. In fact, they're not that interested in investment markets. So they put it in place and they don't want to talk about it anymore. And it grows better. So on average, women earn about 1% more than their male counterparts in the markets.
Interesting. Yeah, we often talk, focus on your asset allocation, creating a good asset allocation, be confident and have conviction in what you hold and let it sit, right? Don't tinker with it, kind of remain hands off. And yeah, we often talk timing the market is a loser's game, right?
Yeah, and I think that's where advisors can really add value. It's that
Mhm.
behavioral finance piece. I'm sure many of your audience have had to talk people off the
Yeah,
ledge. I mean, during the pandemic when the market just tanked, 08, 09,
yeah,
2000. You have to keep people invested because it's extremely difficult to recover from selling low. I mean,
yeah,
it's impossible,
yeah,
frankly.
exactly. Once you lock in those losses,
Yeah.
very hard to get them back. You talked about behavioral investing, and then we're talking about the gender gap and gender bias. How can, and you mentioned it a little bit earlier, how can financial services or this investment industry change that narrative and have women more involved in finance? Does it start like education in college or high school, or, do you have any thoughts
Yeah. I think education all along, I mean, parenting.
there? Mhm.
Don't just talk to your sons about investing. I
Yeah,
mean, girls understand math, they get finance,
yeah,
but you have to engage them. And from the advisory perspective, many firms out there say they have a women's division, let's call it. And they basically are offering the exact same products and services, the same advisors, the same approach, but they're changing their marketing materials to pink. Change the font to pink and you've got a women's division. It doesn't work that way. I mean, in our office where we try to focus on women,
yeah,
there are no Michael Jordan cutouts of him doing a layup. There's no ticker symbols going across the room. There's no CNBC on as they walk in.
yeah,
That women don't resonate with that at all. In fact, if you want her to shut down, that's the office that you have. And so we actually have our office feels a little bit more spa like. You walk in,
oh,
you sit on a couch, you get your favorite beverage, you sit down and talk about her goals, her dreams, her values. What is it she's trying to achieve? That's the starting point with a woman about her portfolio is to what end? What is this money for? Only then can you really connect with a woman because she's not going to talk to you about her pocketbook unless you understand her values,
mhm,
right? And that's just a very different conversation than I have with my male clients who come in and, they want to do tax loss harvesting and they want to generate alpha and what do I think about
yeah,
crypto and what do I think about tech and AI? It's it's super focused on returns.
yeah,
Women aren't that in my experience, particularly boomer women. So I
mhm,
think that narrative and the approach has to change if we want to retain these women. And it's incumbent upon us to do that because they control so much of the nation's wealth and that number is growing. That is
yeah,
going to be inherited by millennials. And so we don't want that those assets to be wasted away. We don't want them sitting under the mattress
yeah,
or it, money market's not bad today, but average money market is 2 to 3%, right? And it's been way lower than that in the
yes.
last many years. And so I think we need to educate women in a different way.
Yeah, that's fantastic. I often, I'm not gonna lie. There's times during the pandemic, and you heard all the meme stocks, and you had the fear of missing out, right? I had the
Yeah,
fear of missing out, but I
yeah.
feel as if that's more male driven, right? You have so
Ryan,
many
you're such a
guys that
boy. You're such a boy. I
I
mean,
know, right? Although I didn't really understand Bitcoin or anything, so I never got into it. It's like
yeah.
it did,
Yeah,
but
just stop that. It just doesn't work. I
yeah,
mean, I have a male advisor that works for me, and I went on my soapbox about how men and women are different investors and how women are better clients because they stay the course. And he totally didn't believe me. And about 4 years later, he said, "Boss lady, I think you're right." because things happen. The male clients are the ones that are calling, and they're like, I want to get into crypto. I want to, these high risk, volatile things where it's literally you're kind of gambling. That's
Yeah.
that's not the way to preserve the nest egg. I mean, if you're
Yeah.
building for retirement, and I always tell my male clients, take a couple $100,000, put it in your own account, and
Yeah.
you trade it the way you want to scratch that edge. But we're not going to do this with your nest egg, right?
Yeah, that's, when I was in the industry with a financial planner in the during the financial crisis, that was what we did. We were like, okay, you want some play money that's really
Yeah,
risky? Here you go. It's going to be in the brokerage account. Here's a certain percent. Have at it. We're not going to
yeah,
do any recommendations. It's all on your accord, right?
yeah.
And you,
And I can't tell you how many times they've come back at me and they're like, I thought I could outperform, but I didn't. So I'm going to stop,
yeah, you're
right?
exactly right.
Yeah,
And going back to your comment about education and the conversations you've had, um, when I really got interested in the industry back in high school, my parents always have people over and cocktail parties and dinner parties. And I would always kind of have conversations with my dad and his friends about investing. And one of the things I remember most is my dad would talk about, he made some money off of Amgen options and so, and
yeah,
he didn't have much for investment, a few $1,000s, but it was always the males in the kitchen talking about that over
yeah.
some cocktails, and the females were somewhere else. And um, now I'm in the investment industry, and my sisters are doing other things and
Yeah,
calling
I mean,
me
I, I,
about
I think I
investing.
think that's it. And like I have events for women only, and we
Okay.
talk about things that women really care about. For example, if boomer women, I mean, there's a true pandemic going on with gray divorce. Gray
Okay.
divorce is growing at double the general divorce rate, and it's two-thirds of the time driven by women. These are
Hmm.
my clients, right? And
Yeah.
so talk to them about things that are impacting them, their generation, and their wealth. So naturally, I got into the gray divorce space because that's what my clients are going through. I also know that once women have had the profound experience of raising kids, they've done that, they've had a career, now they're sitting on a nest egg, but they don't really have a reason to get out of bed.
Mhm.
They want to make the world a better place. So, yeah, we created a sustainable investment platform. And as much um, pushback as ESG investing has gotten, we started that platform in 2021, I believe.
Okay.
Immediately, we got somewhere like 50 to $100 million of assets on the platform. We've had not one defection through all of this politicization of ESG. And,
Interesting.
and I still have clients coming to me, if they're wary about ESG index funds, because there has been greenwashing, let's face
Yes.
it.
Yep.
This is self-reported, and I think a lot of firms used it as a way to attract investors. They
Yep.
charged higher fees. They had more, bigger carbon footprints than their non-ESG index funds at times. And so there was a lot of greenwashing. However, what I find is that most women, they don't want to throw the baby out with the bathwater. They're just looking for another way
Mm.
to get what it is that they want. So whether that's, thematic investments like invest directly in a solar farm,
Yeah.
or whether it's customization, exclude these specific firms that I don't want from my portfolio. Something like 80% of boomer women still want to invest with their values, and
Mm.
something like 99% of millennials,
Yes.
male and female, want to invest in alignment with their values. So I don't care if you don't call it ESG. The demand is
Yes.
there, and I don't think it's going away.
I'm really glad you brought that up. And you talked about earlier about how women want to invest more in their values and morals, and use their pocketbook to invest in things they believe in. And you're exactly right. We're seeing that too at Zephyr, with millennials as well. But we're also seeing, that ESG has become very political and greenwashing.
Yeah,
We have ESG ratings within Zephyr, and I've done some research on it. It's interesting. These ESG strategies that are in the name and all this stuff, when I compare the ratings to the Spider, just a plain S&P 500, the S&P 500 has just as good at ESG ratings as this
yeah,
higher fee ESG active strategy.
yeah.
You can talk, well, maybe because the Spider has more tech in it and higher weighting the tech, and they're more ESG friendly. But how can we solve this negativity towards ESG?
I think we're going to have to change the name for one thing.
Oh,
There's not a portfolio manager that I know in the industry who doesn't consider these factors when they're doing their fundamental analysis of stocks. How can you not worry about the governance of a
yeah,
company when you've had a Wells Fargo and a Volkswagen type event happen, right?
yeah,
How can you not worry about an oil spill if you're owning a gas company? Of course, that's part of it's good investing, right?
yeah,
However, the term ESG has now been completely aligned with a woke agenda. It's become so political. And I do think there's some merit in the accusations of greenwashing, as we just discussed. So I think sustainable investing in alignment with your values, is going to have to be more thematic, more directed. I think the mistake that we've learned is that no one company can be a 10 on E, S, and G, right? And take Tesla as an example. I mean, arguably, Tesla is doing more for energy transition
yeah.
than 99% of other firms, right? Yet they got deleted from the MSCI ESG fund because of governance. So you just can't be all things to all people. And I'm going to counsel my clients to pick those one or two things that you really care about. Is it gender parity? Is it women in the C suite? Is it climate? Is it gun control? And then you exclude companies that you don't want to support potentially from your portfolio,
Mhm.
or you actually buy those companies so you have a seat at the table and you can vote proxy, as an example, right? But you can't do it all in any one fund, in my opinion.
Yeah. That's a fantastic point. We there is that struggle with ESG. A few years ago, we thought, yes, this is it, and you're right, it's the name. And how do you, yeah, fit into the whole ESG? It should be separate. There's a E, there's a S, and the G. Where do your values align, right? And let's personalize those investments, not just ES and G, because to be honest, like living in Lake Tahoe, everything is environmental. So I'm going to be focusing more on the environmental. But you're right. Like I don't want to invest in a Enron or Volkswagen, the
Right.
governance. So that's very important. And you're exactly right. If you're doing a very proper due diligence and research on a company, that governance might be as important as E and S. Um,
Right.
it's a
Right.
struggle.
It really is a struggle. I think we all wanted to believe that there was this panacea, right? That you could invest in a fund. It was good for the environment. It had good governance. It had everything that you wanted, and you would get potentially better risk adjusted returns. It just was too good to be true. You can't have it all, right?
There's no
You're
free
going to have to just
lunches.
pick. Yeah, you're going to have to pick. The
Yeah.
sad thing about it, though, is let's say that you do decide that you're going to customize or that you're going to specifically invest in a women's venture backed fund,
Mm.
right? Very few people can do that. So it's not as democratized as it would be if you could just buy an ESG fund, right? You could do that. Anybody with an IRA can do that. But you've got to have $250,000 general minimum to get into some of these other funds. And let's face it, if it's VC, it's pretty risky. So you're not going to do that with 100% of your portfolio. So it saddens me that the customization is not yet there for the overall population, but I think it's coming.
I do too. I think, we deal with a lot of separately managed accounts, and it kind of goes along with what you're saying. Separately managed accounts, we feel, is a fantastic way. You can add customization. You start with a pool, you can remove names, but there's still that high buy-in of $200,000. Although that is coming down compared to what it was, 10 years ago. So hopefully that comes down even further with technology and maybe direct indexing and some other things that maybe it brings down the accessibility to customization and customized products to you know the broader public.
I think so. And young people, I mean, let's face it, right now the money is with boomer women.
Mhm.
Eventually it's going to be to our millennials, right? When the women die and they're also the millennials are earning their own money, they're super conscious. I mean, they won't buy a product as a consumer if they don't believe in the company. So there's more than one way to live out your values, right? One is investing, one is philanthropy, one is boycotting products you don't,
Yeah.
and that works. I mean, believe me, couple companies are very interested in selling their products, right? And so if you suddenly decide that you know, Dick's Sporting Goods is bad because they are selling bump stocks and you stop buying at Dick's Sporting Goods, they will change that as they did in 2018 with the Marjorie Stoneman shooting incident, right? And so I think in this country, for better or for worse, money talks. And as investors and as consumers, we have an enormous amount of power. My goal is to help women and all my clients understand that power and use it to create the world that they want to see.
Holly, that is fantastic. I think that is a great point, a great recap to kind of close this conversation. Thank you so much, Holly. That was really a fun conversation. You dropped a lot of insight and just information about, you know, people need to be aware of this change that's coming up, and if you're a financial advisor, start having conversations with the wife or the children or the girls, because it's very important. Holly, thank you. Where can people find more information about yourself and Stearns Financial Group?
Yeah, you can just Google stearnsfinancial.com.
Okay.
I would say my name, but it's way too difficult for anyone to get that right. So I think stearnsfinancial.com is the easiest way.
Yeah, perfect. I will
Thank you.
include a link to that in the show notes, and then yes, you have a great presence on the website, so people can go there. Thank you, Holly, so much for joining the show. It really was a fun conversation. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you, and have a great rest of your week.